welcome to this very exciting webinar. Today, we're diving deep into the often murky waters of expat investing. You know, it's like snorkeling in a foreign country, beautiful fish, breathtaking coral, and then bam, you step on a sea urchin. To guide us through these treacherous waters, we have the investment guru and part-time sea urchin dodger, Tom. Tom Zachystal, not just a name, but a legacy. As the pioneering force behind international asset management, he's not only its president and chief investment officer, but also a global traveler with a treasure trove of international exposure. From the bustling streets of Prague, to the iconic Wall Street, from being an astute international business consultant to mastering the depths of engineering for the oil services firm Schlumberger, Tom has truly seen it all. It's this rich tapestry of global insights and financial acumen that makes IIM a beacon for expatriates, non-US investors, and even our fellow Americans. Now let's talk credentials, because Tom's collection is enviable. An MBA in global management from the prestigious Thunderbird University, a bachelor's in science and civil engineering from the University of Alberta, and a triad of titles: a Chartered Financial Analyst, a holder of the British Investment Management Certificate, and a certified financial planner. To top it all, he's been at the helm of investment portfolios since 2002 and is a past president of the San Francisco Financial Planning Association. So when we talk about navigating the complex waters of expatriate finance, there's no captain more equipped than Tom. About me, I'm Randall Brody, your go-to guru for all things income tax, especially when it comes to the intricate world of expats. As a visionary behind Tax Samaritan and Peace of Mind Tax Help, I've dedicated my career to untangling tax woes. Over the years, I've waved my magic wand to dissolve a staggering $800 million in tax debt, benefiting over 9,500 taxpayers and counting. My insights also find their way to the pages of the esteemed Enrolled Agent Journal, where I'm a regular contributor. But life isn't just numbers and tax codes for me. As someone who's deeply passionate about travel and blessed to be a father and grandfather, I truly resonate with the nuances of expat living. Apart from the world of taxes, you'll find me cheering for the Vegas Golden Knights and the Las Vegas Raiders, usually in the company of my family and my rather sizable fur companions, a lively Labradoodle, a majestic Great Dane, and a spirited Saint Berdoodle. And when the mountains beckon, I'm off snow skiing. Welcome, Tom.
Well, thanks, Randall. That's quite an introduction. As Randall mentioned, have sort of a multi-cultural, let's say, background myself. I was born in Prague, grew up in Canada. I've lived in the States, in California for about 25 years. And I used to be an engineer for a company, Schlumberger, in the oil services industry, and worked as an expat for 10 years in a lot of interesting places like Nigeria and Holland and the Middle East and Russia and Papua New Guinea for a bit. So I have quite a bit of expat experience myself, but about 20 years ago, I went through a career change, as many people do. I ended up with Merrill Lynch in California, and then with another investment advisory firm in San Diego that catered to expats. And I started my own business in 2002, which has become International Asset Management. We have clients in over 30 countries now. We deal with about 150 households, have 5 advisors, and so, but what distinguishes our firm is that we specialize in Americans living abroad, in U.S. expats, if you like, and that's 90% of our client base. You know, many other companies in the States will deal with expats. Well, not very many these days, actually, but some companies will deal with U.S. expats, but we actually specialize in that. That's the vast majority of our clients.
Thank you, Tom. So diving straight in general, how does an investment strategy differ for expats? I mean, is it like choosing between a tequila in Mexico and whiskey in Scotland, or is it more complicated than that?
Well, I can see where your head's at there with the alcohol illusion. Lots of different types of choices there for sure. I would say, how does an investment strategy differ for expats? There's sort of three areas where I would say it's different. There's sort of regulatory considerations, investment considerations, and then financial planning considerations. So on the regulatory side, this comes up mostly in very regulation-heavy places like Europe or Australia, or South Africa has a strong regulator. And so one of the things we see, and also obviously U.S. regulations, and so one of the things we see, for example, is that for many people in the US, they'll still use mutual funds in their investment portfolios. They're used to that. Well, if you live overseas, it's hard to get access to US mutual funds unless you have a US address that you're trying to use. But for people who are permanently overseas, it's hard to have access to US mutual funds because they're considered investment companies under the law, and they're supposed to be regulated, licensed where they're offered as it goes. And so most US mutual funds aren't licensed in outside the USA. Then there are regulations such as, for example, the PRIPS regulation in Europe, which makes it difficult to buy US exchange traded funds in taxable accounts sometimes. And then there are PFIC issues that I'm sure you're familiar with, Randall, and a lot of US expats are, where if you buy a non-US fund in a taxable account, then you have burdensome and potentially expensive U.S. tax reporting issues. So those are the kind of regulatory considerations. Investment considerations are things like, who can you actually deal with? Because a lot of the brokerage firms and advisory firms in the U.S. and in some of the banks even don't really want to deal with expats anymore. So we'll talk about that a little bit later. But that's a big issue for Americans living abroad these days. Then there's currency risk. A lot of people talk about this. If you're spending in euros or another currency, but your savings are mostly in US dollars, then you need to think about currency fluctuations, especially if you live in a place like an emerging market, where there's a risk of a currency devaluation maybe. So potentially, perhaps you don't want to keep a lot of money in the local currency. Because of the risk of devaluation, and then if you travel, it might make it a lot more expensive. Then there's also investment considerations like real estate or golden visa programs, where you might want to invest in a country, buy a property there worth a certain value, and thereby gain residency and potentially citizenship. Portugal has a golden visa program that's been popular lately. Spain does as well, other places. And then finally, there are financial planning considerations, things like you might have a 529 plan for college savings for your children in the US because college is so expensive, but it's not so expensive outside the US typically. You might not even need to save for it. It might just come out of cash flow. And what about this 529 plan? If your student, your child doesn't go to US college or university, is it still useful for you? So things like that are financial planning considerations. Also things like pension and retirement accounts and Social Security. You may not be able to contribute to a retirement account when you're working abroad anymore, or there may not be big tax benefits to doing that. Social Security, you might get it from one country or both countries. There might be a totalization agreement that you can use to offset credits. Then there's also different costs, such as, for example, medical costs are a big deal in the US in some cases. But if you're living abroad, you might have national health, or you might have more generous government benefits, typically outside the US, like in many European countries. But that might come along with higher taxes as well. So financial planning considerations like that, also around taxation, estate planning, and insurance, things like long-term care coverage isn't very prevalent outside the US, for example. And finally, another issue that comes up on the financial planning side is, what about that US property when you move overseas? The house you live in, should you sell it before you move abroad or after? We get a tax deduction, a tax credit for capital gains credit for selling personal property in the US, but that may not be available overseas. But on the other hand, in your country of residency, there may be no tax if you're just recirculating that money into a new home. So those are important. So those three considerations: regulatory, investment, and financial planning. The investment strategy and the financial planning strategy can be quite different for expats.
Interesting. So, would you say that an expat's investment strategy should be as adaptable as their taste in drinks?
Yeah, well, your taste might change over time as well, right? And you might end up in different countries or coming back to what you left originally. So definitely that there has to be some flexibility there. And also,
Awesome.
it's sometimes fun experimenting, right?
Of course, absolutely, absolutely. So, all right. So, moving on, should expats invest in the U.S. or their country of residence? I mean, is it like deciding between eating a Big Mac in New York or trying snails in France?
Yeah, I like your food illusions. Food and drink, is that what
Thank
it's
you.
all about with you there, Randall? Um, we generally recommend that US citizens and US taxpayers, so green card holders, keep their investments in the US for a number of reasons. First of all, you're going to end up filing US tax forms, even if you don't owe US tax. Typically, you have to file the forms, and then it's useful to get things like 1099 forms from your investments, and these will only be issued by US institutions. So that's already one big reason. But there are other reasons. For example, retirement accounts. They can't be moved anyway. I mean, you can't set up an IRA account with uh, Credit Mutual in France or something like that. They don't even know what an IRA account is. It's a US trust. And so it has to be with a US institution in that case. But there are other considerations. Like, for example, in the US, we have what's called SIPC and FDIC insurance for banks, SIPC for brokerage firms, covers $500,000 in an investment account. And this is insurance against the default of an institution, which hopefully will never happen. But in 2008, for example, when we had the banking crisis, it did happen. And so it's nice to have that insurance. In many other places, it's much lower than that. In most other places, I think it's something like 60,000 euros in many places in Europe, for example. And then finally, the US is a very competitive financial marketplace. So generally, you have lower fees and an access to a greater breadth of investment products. I mean, we have a business in Spain as well, which is regulated in Europe. And what we see from the banks and brokerage, the local ones, banks and brokerage firms, is that it's like it was in the 80s in the US. You pay an upfront cost to enter a mutual fund. It's all mutual fund based. And then, so that might be 5%, and then you pay 3% annual fees or something like that. So the US is a very competitive marketplace. Then in terms of which brokerage firms are US expat friendly, well, first of all, it's the banks, the brokerage firms, and the investment advisors, if you want investment advice, that you need to talk about. Banks are typically less of an issue. Some good banks that are expat friendly are the State Department Federal Credit Union, sdfcu.org. They are the credit union that deals with the people working in US consulates and embassies around the world. So they're quite used to dealing with expats. And then WISE, which used to be called TransferWise, which is really a currency transfer and exchange platform. They're becoming more and more like a bank, and they're actually paying a decent rate of interest on if you're holding money with them. So that can be another banking type product. I believe they might even have a debit card these days. In terms of brokerage firms, you've got three flavors. The ones that don't deal with expats anymore. So these are firms like Merrill Lynch. It's the years ago they started sending out letters to their expat clients that they don't want to deal with them anymore. Then you have the firms that'll deal with some countries but not others. So these are firms like Charles Schwab, Fidelity, other brokerage firms. They're country specific for some reason. And then there's one firm that's pretty good at dealing with expats living almost anywhere, which is Interactive Brokers. But they have some challenges and they're not particularly user-friendly. So these are the firms that will hold your money. And in some case, like Merrill Lynch, they'll offer you investment management services, but sadly not for expats. And so then there's also a difference between having what's called a retail and an institutional account. A retail account is where clients, you'll go to the brokerage firm directly, you'll have your own account, you'll manage it yourself. And so, for example, with Charles Schwab in Europe, they will not allow people who have retail accounts with them to access US exchange traded funds. But if you're dealing on the institutional side, which is where firms like us have our accounts for clients, that's fine. We have access to US ETFs at Schwab because I guess we're based in the US and we're managing the portfolios on a discretionary basis. So those are kind of the differences between interactive brokers, say a multi-currency platform, US citizens living almost anywhere. Not very user-friendly, though. No ETFs for taxable accounts for people living in Europe, and they're not a bank. Schwab, much more user-friendly, but country-specific. They won't allow people living in Italy, for example, to hold accounts with Schwab, or the Philippines or South Africa, but France and Germany are fine. Thailand is fine. So country-specific with Schwab, and also with many other custodians such as Fidelity, RBC Dominion, also country-specific. There are a few non-US firms such as Saxo in Denmark that'll deal with US citizens as well. Their costs tend to be higher. You don't get the services you're used to in the States, but they're out there. And then the final category is the investment advisors. That's firms like us, if you want investment management services or financial planning services. So we can't, even our firm, which we have clients in over 30 countries, we can deal with people living in most countries, but we can't deal with people living in Canada or Singapore or Japan for that matter, because we would need to be licensed in those countries to deal with residents in those countries. And the same may happen in Europe in the future, by the way, because already the European regulator is restricting US ETFs and mutual funds and so on. They could restrict investment advisors as well, which is why we set up our business in Spain, so that we'd have a European license to provide continuity to our clients. So those are the three categories of firms: banks, brokerage firms, investment advisors, that you need to be concerned with if you're moving abroad or living abroad.
That makes sense. Now, Tom, a question that's more controversial than putting pineapple on pizza. Pros and cons of using a US address on your financial accounts when living outside the US. What are your thoughts about this?
Yeah, speaking of pineapple on pizza, I remember when I was in Australia, they put all kinds of things on pizzas there. Beetroot.
Ew.
It's amazing. It's tasty, I guess, when you get used to it. But don't forget they eat things like Vegemite as well. So I guess it goes with the territory. So the pros and cons of using a US address on your financial account. Well, the fact is many Americans living abroad do that. They've got either some kind of a mailing address that doesn't look like a mailing address, or maybe relatives, or maybe it's an old address they had once upon a time. So the first question I usually get is, well, is it legal? Well, I'd say it's kind of a gray area. Usually you don't get into trouble for it, but the reason it's a problem for the financial institution you're dealing with, more so, because they have an obligation under FATCA and know your client rules to know where you live, and in some cases to report to the tax authority in your country of residency on your US account. FATCA is a tax information sharing regime that exists between the US and many other countries. It was originally started to find money that Americans were hiding abroad, the UBS thing many years ago. And so what the IRS did, and the US authorities, is through sort of a carrot and stick method, they basically compelled non-US financial institutions to report on accounts held for Americans abroad. Well, these countries said, well, if we're going to do that, you have to do it. And so most of these agreements are reciprocal. And so the US financial institutions have to report under FATCA to your country of residency, to their tax authorities. But of course, they need to know you live there for that. So they want to know where you actually physically are a resident. So it's an issue for them. But it could also be an issue for you. For one thing, many of these institutions are starting to track IP addresses. If you're logging in from Singapore and your address on the account is in the US, sooner or later, they're going to know you're logging in from Singapore, and they're going to ask you the question, where do you actually live? And then they might want to close your account down. Some people use VPNs to get around that, but it's getting harder and harder. They're also finding ways to track addresses in the US. So sometimes they can figure out if that's just a mailing address you're using. If you're living in Mexico, you might have this address in Laredo, Texas. Everybody seems to have an address in Laredo, Texas when they live in Mexico. but they're cutting down on things like that. The other thing you need to be concerned about is if your address is in a state that has an income tax, well, don't forget the state tax authority gets a 1099 form every year. And you're probably not actually filing taxes in that state, but your address is in that state on your investment accounts. And so sooner or later, the question is going to come up from the state tax authority as to why you're not paying taxes in that state since you seem to live there. And then there might also be a difference between if you have a pre-existing account with an institution or if you're trying to set up a new account. For example, Charles Schwab will not set up new accounts for people living in France. But if you've been a client for over 6 months and you've lived in the US and now you're moving to France, they're not going to kick you out. You can keep your accounts and you can change them to a French address. You just can't set up new accounts once you're in France. But in other places, like I already mentioned, Italy and the Philippines, they won't deal with people living there at all for some reason. And this is a fluctuating thing too. Just a couple of years ago, Schwab would deal with people in Italy and Philippines, but not many other European countries. And now things have changed. So New Zealand is another issue, for example, for many firms for some reason. So these things are in flux, and you need to keep your eye on them.
Got it. And I have to know, purely for the sake of curiosity, have you ever encountered any funny or horror stories about this?
Yeah, sure. So back in the day when this FATCA thing first came out, which I think was about 10 years ago or something like that, we were getting letters, and especially had to do with Merrill Lynch at the time. All of a sudden, some people, I remember there was a person in Singapore and they got a letter from Merrill Lynch saying, we're closing your IRA account. Right? You have to move your IRA account because we're not dealing with people in Singapore or wherever it was. Well, they just ignored that. And then they got a check, a $400,000 IRA distributed to them in a check, basically. And they didn't get the check for a while because, it took a while to get to Singapore, I guess. And then it was a panic. Like, what do you do with that, right? You can probably advise on this, Randall. I mean, you can still roll it over within 60 days. And even afterwards, if you're kind of a hard case, you can probably manage that. But yeah, those kinds of things where people just ignored these warnings from companies and had the retirement funds distributed, that used to happen quite a bit.
All righty. On to the next one. Do U.S. or local tax reporting obligations or international tax treaties sound as scary as they seem? How do they affect investment choices for expats?
Right. Well, in a number of ways, actually. So one of the things is that capital gains taxation is often quite different than it is in the U.S. We have this concept, as you know, of long-term and short-term capital gains. If you hold the investments for longer than a year, the capital gains are taxed at a lower rate typically. That doesn't exist in most other countries. In some countries, capital gains are taxed just like income. They don't distinguish between that. And the other thing is the cost basis considerations. So, for example, we have this concept of you buy something, that's your cost basis. When you sell it, you pay tax on the gains, right? Well, if you're moving overseas, then what's the cost basis going to be? Is the cost basis going to be from the time you become a resident in that country? Or is the cost basis going to be from the time you bought the investment? Maybe you've held it for years while you were living in the US, right? In some places, the capital gains tax regime is relatively recent. I remember in South Africa, for example, they didn't have capital gains tax before September of 2001. And I remember about 10 years ago, we had a client living in South Africa. He had some stocks he'd bought in the 80s and 90s, and we now wanted to sell them and diversify the account. Well, we had to do a tax calculation that was different for South African taxation than US, because the cost basis for South Africa was actually from October of 2001. Well, that made a huge difference if he bought those things in the 80s. If we had used the original cost basis, that would have been a much higher tax, capital gains tax to be paid on that. So those kinds of things are quite different. Also, things like, for example, in the UK, there's an exclusion for capital gains up to a certain amount. So you might have a capital gains exclusion rather than different rates of taxation. Dividends, similarly, are taxed differently. Also, we have this concept of qualified and non-qualified dividends in the US that often doesn't exist. Also, local company dividends, like companies that are based in your country of residency may be taxed, or tax may be withheld at a different rate. And tax treaty taxation under dividends can be, under the tax treaty, you might get a better rate of taxation on those dividends than normally. So that's another thing to pay attention to. But apart from those kinds of taxation, there's also the different types of accounts. Some accounts that you would expect to be tax deferred in the US, like a Roth or an HSA or a 529, may not be tax deferred accounts in your country of residency because they're not mentioned in the tax treaty specifically. In the tax treaty, there's usually a pension section. And it'll cover things like typically like IRAs and 401ks, anything that's considered a pension under the tax treaty. But Roths are most often not mentioned. The UK treaty is an exception to that. They mention Roth, but most other ones don't. HSAs and 529s I've never heard them mentioned in any tax treaty. So those kinds of accounts may not be tax deferred for local tax purposes. And then another thing to keep in mind is if you're moving back to the USA, or if you're a foreign national, a non-resident alien of the US, and now you're becoming a US resident, you might have accounts, offshore accounts, for example, that you'll need to get rid of if you become a US resident. And then you might need to sell the things that are in those accounts, and they may have a low cost basis. Well, if you sell them after you move to the US, then your gain is going to be whatever the original cost basis was. It's not going to be the gain computed from the day you became a US tax resident. And so what you might want to do if you're going to sell them after you move to the US is at least change the investments in those accounts so that you have a higher cost basis when you do sell them. Other things come up like the India Provident Fund, for example, which if you cash it out while you're in India is tax-free, but you move to the US and then you cash it out, well, no, it's taxable for US tax purposes. So those are also things to think about when you're moving back to the USA, for example. And you probably know more about these tax treaties than I do, Randall. So, what do these tax treaties actually do? Or do you want to talk about that a little bit?
Sure, absolutely. So US expats definitely have a very unique financial landscape to navigate. The US is one of the few countries that taxes its citizens on worldwide income, regardless of where they reside. So this means that US expats must be conscious of both US tax reporting obligations, as well as the local tax obligations of the country they're residing in. So tax treaties come into play as a bridge between the US and many other countries to avoid double taxation, offering some relief. Sometimes they offer relief in the form of reduced tax rates or potential credits. However, these treaties can also influence investment choices. Some investments might be tax efficient in one country, but not in another due to these treaties or lack thereof. So at Tax Samaritan, we often come across scenarios where an expat's investment, which seems attractive locally, may have unintended tax consequences back in the US. So it's essential to align your investment choices with both local and US tax implications. And that's where expert guidance becomes invaluable, ensuring that your investments don't inadvertently lead to a tax headache. So in essence, yes, tax reporting obligations and international tax treaties can and often do affect investment choices for expats, but it's always advisable to consult with a tax professional like myself, an investment professional like Tom, who specializes in expat tax matters before making significant investment decisions. So, in essence, understanding these obligations is like knowing if your Halloween candy is filled with chocolate or a surprise tax bill.
Yeah, nobody wants a surprise tax bill. I'd rather get a surprise tax refund. Those are a little bit rarer than the tax bills, I think. Yeah, everybody has questions on tax. U.S. expats, they always have questions on tax. And as financial planners, we know enough about to be dangerous, but we send those people your way. One of the things that comes up and that I've been hearing more about lately is what about the mandatory tax withholding on IRA distributions? I've heard it's 10% for U.S. expats, but it could be 30% if you're a non-resident alien. What about that?
So yeah, you're on the right track, Tom. For U.S. expats, the mandatory tax withholding on IRA distributions is generally 10%. However, for non-resident aliens, it can indeed be a whopping 30%. This distinction is critical as it can significantly impact the net amount that you receive from such distributions. So planning and understanding your tax status can make a difference in your retirement finances. Remember, it's important to always consult a tax expert like us at Tax Samaritan to optimize your IRA distributions and ensure compliance. So last but not least, the million-dollar question, or given the current inflation, the $2 million question. So how are global challenges like high inflation and interest rates stirring the expat investment pot? Is it like adding a spicy pepper to an already sizzling dish?
You've got some great ways of looking at things, Randall. Yeah, certainly high inflation, even though I guess it's temporary, it's coming down now, makes a difference. It's kind of it's an individual thing to some extent, because, for example, inflation tends to be higher in emerging market countries than developed countries anyway. So if you're living in a place like Mexico, you can expect to have a higher inflation rate than a place like the US. If you're living in places like Argentina and Turkey, well, then you've got real inflation problems. So that's the thing. And inflation is also different depending on your lifestyle. For example, the price, oil prices went up because as a result of this Russia-Ukraine thing. And so gasoline prices went up, especially in Europe. But if you don't drive a car, maybe that affects you less. Or things like travel costs. Right now, they're going up. Everyone's traveling again. During COVID, nobody was traveling. Maybe that makes no difference to you if you're not traveling, right? Or things like medicine and that kind of thing. Those kinds of costs, if you're covered by national health, that may not be a big issue. In the US, it might be a bigger issue. The other thing to remember is it's also different whether you're working or not. If you're working, then inflation probably drives your salary up as well. I mean, salaries tend to increase higher than inflation in most cases. But if you're retired or something like that, that could make a bigger difference to you because your income doesn't necessarily go up. You might have income from pension and annuities. It might be inflation index, or it might not. So it's very much depends on where you live and your lifestyle as to how much inflation affects you. But the other thing about inflation, there are some benefits to it, you might say. For one thing, interest rates go up when inflation goes up, and we've seen an era of very low interest rates lately, which means that investments such as bonds have not been attractive, especially long-dated fixed income investments, because you could get practically no yield even in a 10-year US government bond for many, many years. And then if you invested in that and interest rates inevitably went up, well, then the bond prices go down. So you take a bath on your bond holdings in 22 when that happened. But now with interest rates so much higher, again, it's maybe fixed income investments are more attractive. And if you're retired, especially for financial planning considerations, it could be nice to have some of these fixed income investments, even annuities, if you want to go there. Although we don't sell annuities, but those kinds of investments are more attractive now because interest rates have gone up. And the other thing that happens is when interest rates go up in the States, the US dollar tends to strengthen. It also tends to strengthen during times of strife, like in 2008, for example, the banking crisis, or in 2020 when COVID hit in February and March and the stock market plummeted. The US dollar tends to strengthen then as well because people run to the safest investment out there, which are US Treasury bonds. And so if you have some of your savings, some of your investments in US dollars, and interest rates go up in the US, then maybe that helps offset some of the inflation you're feeling, because now the exchange rate is better for you from those US dollar savings to your local currency. So, all of that, I should mention sort of as maybe as sort of a closing thing, if you like, the value of financial plan, because in a financial plan, we can model inflationary pressures. We can model different types of, say, returns on investment. And it's really quite important when you do you do a risk profile. That might tell you how much risk you might want to take on in an account, but a financial plan could tell you what rate of investment you might need in your accounts to realize your financial goals, depending on investment, depending on inflation and other scenarios.
Yikes. So that's a lot hotter than a jalapeno on a summer day. Well, Tom, it's been enlightening and entertaining and at times a tad terrifying. Thanks for guiding us through the labyrinth of expat investing. All right, folks, that was a whirlwind of insights, and I hope you've jotted down some notes, or at least remembered to dodge those pesky sea urchins Tom has shared with us. But now let's shift gears. I know many of you have burning questions, and I promise it's not just from the spicy investing talk. It's the moment we've all been waiting for, the Q&A session. So feel free to drop your questions in the chat, and Tom and I will do our best to tackle them. Who knows, your question might just be the one that helps another expat navigate their investment journey. So before we jump into the Q&A, a quick note for all of our listeners out there. If today's discussion resonates with you, or if you find yourself navigating the complex maze of expat taxes and investments, remember you're not alone in this journey. At IAM and Tax Samaritan, we're here to guide, assist, and ensure your financial decisions align with your tax obligations. So if you're interested in a free personal consultation with Tom regarding investments, please drop a note in the chat. Before we dive into your questions and unravel more financial mysteries together, Tom, do you have any final words for our audience?
Well, I just want to say clearly the reason for this webinar is to raise awareness for our services. And so what differentiates our company, International Asset Management, from other U.S. financial advisory firms is the fact that for over 20 years, we've specialized in investment management and financial planning for Americans living abroad. Other U.S. firms have U.S. expat clients, but for most, this is a sideline, whereas 90% of our clients are Americans living abroad in many countries. As a result of this focus, we're much better versed in cross-border regulatory investment and financial planning matters than these U.S. firms. We also have an extensive network of cross-border professionals like Randall and Tax Samaritan, who specialize in services such as taxation or estate planning or immigration. Perhaps most importantly, we take a proactive approach to ensuring the continuity of our services. At a time when many brokerage and advisory firms have curtailed services for U.S. expats due to regulatory burdens, we've invested to ensure we can continue to serve our clients in ways such as obtaining a European advisory license to guard against the possibility of the European regulators may mandate that only EU licensed firms can offer financial services there, and by partnering with U.S. expat-friendly custodial firms such as Schwab and Interactive Brokers, and professionals offering complementary cross-border services like Tax Samaritan, for example. When I started this firm 20 years ago, I just wanted to deal with interesting clients. I was an expat myself for many years, and I just find expats to be very interesting. Everybody has a story. And also, we wanted to bring a level of expertise to what can be complex cross-border financial planning issues and investment matters. And that's why we have a focus on expats.
Let's see. Our first question, Tom. With all that's going on in Israel and the Ukraine, where are you investing right now?
Yeah, that's a question that we seem to get quite a bit lately. And I would say that for it hasn't the Ukraine and the Israel thing. If you look at what's happening in investment markets lately, there doesn't really seem to be a big reaction due to the Israeli crisis right now. Um, we haven't seen the market go down in the last few days or something like that. Oil prices went up briefly, but there hasn't been a big reaction. Now, if this gets bigger and it draws in countries like Iran, for example, or other countries, then probably there will be a reaction. But this kind of thing, we don't really make a lot of changes around it. Because it is ultimately a temporary situation. Now, the Ukraine conflict could last for a while, but the effect of it, so for example, the inflationary effect, the higher oil prices that stem from that, those seem to be temporary, and there are adjustments being made by various countries to deal with this. So we haven't made any changes for that. Where we do make changes, though, is when there's something like interest rates going up, for example, because that's an investable event. When interest rates go up, bond prices go down, but the yields on bonds go up. And so now there's an opportunity to lock in yields, even on U.S. Treasuries, over 5%, which we haven't seen for a few years. So things like that can make a big difference in the management of your investment portfolio. But things like these crises, or even the government shutdown, that's probably a 1 month event or a 2 month event. It'll affect the markets for a bit, but it won't be a permanent thing. And so we don't really make big changes around things like that.
All right, great. Our next question, I believe, is for me, one that I'll tackle. I live in the US and I'm a resident alien here. If I sell my house property in Europe, do I need to pay some tax in the US, like the capital gain tax on a property? And how is the cost basis determined in this case? So whether it's a property in the US, in Europe, or elsewhere, the tax treatment as far as capital gains is exactly the same, whether it's a property in the US or elsewhere. There are some differences. However, if it's a rental property, there's differences in depreciation methods, but other than that, it's very similar. Let's see, our next question. What is the typical profile of your clients, as far as investment sizes? I'm surely interested in having a consultation to assess usefulness and if I'm a good fit for you as well.
Sure. So first of all, feel free to book a consultation with us. We do initial consultations for free. And that's sort of a get to know you kind of thing, where we learn about your situation, you learn about our services a little bit, and we see if there's a good fit. So that's a free consultation. And then we have two flavors of services, if you like: investment management and financial planning. On the investment management side, we have a minimum of $200,000 for account size, or let's say relationship size. And then you asked about our fee structure, I think, as well. So we have a couple of fee structures on the investment side. We have a tiered fee structure that goes from 1% to 1.5% per year, depending on account size. That is for where we're managing accounts using individual securities, stocks, bonds, that kind of a thing. We also have a fee structure where we use mostly exchange traded funds. That has a lower fee, 1% or less on larger accounts. So there's that. That's where we're using ETFs. It's less work for us. So we charge a lower fee for that. For financial planning services, so first of all, we do free financial planning for our investment management clients. If you just want a standalone financial plan, then the fee is a one-time fee of between $1,500 and $3,000 based on complexity. So we send you a questionnaire, and based on your responses, we quote you a fee, but it's in that range. So that's kind of the typical profile. Other than that, who are our clients? Well, they're expats. They're usually Americans living abroad. Sometimes they're not Americans. There may be non-resident aliens in the U.S., but they have U.S. accounts, U.S. retirement accounts typically, and they live all over the world. And we just like to have interesting clients. So that's our profile, I guess.
Awesome. So once again, if you have questions, just click on the Q&A, not the chat button. My apologies. Our next question, Tom, if we can't buy non-US mutual funds due to PFIC issues, then what is the best way to invest in local currency?
Right. So the issue with mutual funds is pretty much wherever you live, right? So if you buy a non-US mutual fund, you're going to have this PFIC issue where the tax reporting in the US is burdensome, and potentially you get taxed on the gains as they accrue and so on. So you don't want to be investing, and you may not in non-US mutual funds. At the same time, you don't have access to US mutual funds if you live abroad, and maybe not ETFs. So how do you invest in local currency? Well, if you do have access to ETFs, even US ETFs, there are obviously non-US ETFs you can invest in. Vanguard, iShares. Plenty of companies offer non-US ETFs. So as long as they're not hedged to the US dollar, that is, they float with the foreign currency, then you'll have a non-US currency investment in that market. The other way is that some custodians, like Interactive Brokers is particularly good at this, will allow us to buy on non-US exchanges. Most custodians will actually allow that, like Schwab will do it, Fidelity will do it, but there you have to place the trades verbally over the phone, and it's like $30 a trade sometimes. But Interactive Brokers, it's an electronic process. You have access to many different exchanges around the world, and so we can buy individual securities on those exchanges in local currency bonds as well, in some cases, like in Europe, for example. So it is possible to put together a portfolio that is in local currency in many places as well, using Interactive Brokers as custodian.
Awesome, thank you. Our next question, are there certain investments that I should avoid as a US expat due to tax complications?
Yeah, well, so we already mentioned the mutual funds, which have the PFIC issues, and then we talked a little bit about the various types of dividends. You know, sometimes in certain countries, especially in European countries, you don't necessarily want to. You have a different rate of taxation on dividends for local companies versus dividends for companies that are located outside the U.S. So that's another consideration. We also talked about the types of accounts. That can be a bigger consideration. Some of these U.S. accounts, like Roths and HSAs, may not be tax deferred in the local country. So those kinds of things are something to keep in mind. And you know, along with that, Randall, here's a question for you. You know, what about pension plans and insurance policies? Do they have PFIC reporting issues as well?
Yes, that's a great question. Very complex question. So they can generally be treated as PFICs and have PFIC reporting requirements. Generally, that will always be the case with a private pension plan, and as well as insurance policies, barring any treaty exception. So the next questions, Tom, that I have for you: how can I figure out how much I can spend in retirement and not outlive my savings? That's a great question.
Yeah, that's a great question, and obviously for many retired people, that's a question. Also for people saving for retirement, right? How much do you save? How long do I have to keep working? That kind of a thing. And that's where the financial planning comes in. Because as I mentioned before, you know, typically you go into business with an investment advisor. They'll do what they call a risk profile. We'll do a risk profile. We have to do it by law in the U.S., many other countries as well. So we do a risk profile, and that kind of tells us, well, what kind of volatility might be acceptable for you in the investment accounts, because usually the higher the return, the higher the volatility as well. you put all your money in Apple. That's been a great investment, but it was down 50% in 2008. So that's just that just gives us an indication of what you can take, how much, what your risk tolerance is. The financial plan, if we do it, it gives us a sense of what rate of return you might need on your investments to realize your financial goals. And an important goal might be not outliving your savings in retirement. And so that's how we do it. And the thing is, you're doing these projections over 20, 30, maybe more years. So the one thing I can guarantee you is the numbers aren't going to be right 30 years from now, the ones we come up with. But what we can do is scenarios. And so we can do a scenario where, you spend less, or maybe you might be able to spend more than you think. We can do a scenario where the investment rate is lower because maybe you have a more conservative portfolio. And also as part of that, we do what's called a Monte Carlo analysis, which is a statistical approach, because, you don't just make 6, 7, 8%, whatever a year on your investments year in, year out. That might be the average rate of return, but there are big fluctuations in that, right? In 2020, that was a down, or 2022, that was a down year, for example. And then we've had many years that were also very good years. And so what the Monte Carlo analysis does, the statistical approach, is it looks at these historical rates of return and the fluctuations in investments, and looks at many different paths that your investments might take, and whether you'll run out of money, because it might make a big difference if you retired in 2008 or in 2007, and right away, first year in retirement, you're not earning any money anymore because you're retired, and your investment portfolio goes down by 20, 30% all of a sudden, and then you panic and sell everything. So that's a big difference from if you retire and the first year your investments go up 10%. So that's the kind of thing that Monte Carlo looks at, and that's also useful to do, and that's part of the financial planning process as well. A rule of thumb used to be you can spend 4% of your savings a year in retirement and never outlive your savings, and that was based on research that had been done over 30-year time periods, where basically if you did that and you stuck to it, then you never ran out of money. So that's kind of a rule of thumb, but there are ways to optimize that. For example, if you take out more in good years and less in bad years, then some recent research has shown you can get that up to 5 or 6 or even 6% of your income. And so what we see is more often than not, what we see is people not spending enough, to be honest. I mean, a lot of our clients have some money, they have some savings, but they're worried about outliving it so much that they forget to have a good time while they can. And that's important too. That's as important as having money left over on your last day on earth. It's also important to enjoy yourself while you can. And a financial plan can help with that as well. You might be able to spend more than you think. So that's also important to know.
Great. Our next question, our last question, fortunately, we're running out of time. What happens to a 529 plan account if the student for whom it's intended ends up going to school outside the U.S.?
Yeah, that's a good question. And it's, a 529 plan is quite common in the U.S. A lot of people end up with these plans for college savings, and then maybe we have a case right now. Our client in France set up 529 plans for his grandkids who were living in the States at the time. He's a U.S. citizen, but they ended up moving to France, and now they're going through college in France, where it's not very expensive for one thing. So the 529 plan is overfunded, but they're also attending what's called a non-qualified financial institution. So the tax benefits of a 529 plan are only available if you're attending a qualified institution. So a qualified college or university is one typically where U.S. government aid is available, government loans. And it'll have kind of a number associated with it. And so practically every U.S. college or university is qualified, and there are many outside the U.S. as well. But if you're attending a non-qualified institution, well, then what happens is when the money comes up, there's a 10% penalty because it's a non-qualified institution. You can take the money out anytime you want. It doesn't even have to be for college, but you pay the penalty and you pay tax on the distributions. So it's still worth doing the 529 plan. The other thing you can do is you can transfer the plan to a sibling, or there's actually a lot of people. You can use it yourself as the father or the grandfather, or you can leave it in the 529 account for the next generation and just building up, and maybe the sons and daughters of whoever it was intended for originally can use that, the grandchildren. So there are many things that can be done with that, and it's useful to get some advice around that, I think.